fighting financial crime, estimated to be worth over $6 trillion a year, has been around for quite a while. So here to discuss this in relation to commodity trade and finance, we have Mac and Rod. Rod, if you can start with a quick overview, and I know a lot of you will know who Mac is.
Very good. Thanks, Deepesh, and thanks for having me again. Rod Hutchinson. I came from the banking side, had 24 years in banking at Rabo and ABN AMRO. 9 months ago, joined Veridapt, which is a fintech company really focused on monitoring physical inventories in the world of commodity finance.
I'm Mac.
Hi. I've been in the business for about 40 years. About 25 years ago, I spent so much time arguing with people about how this stuff works, because I've never had the luxury of working in a commodity bank. I always worked in banks that did it very reluctantly. That somebody said, you ought to write a book, and I wrote a book about what can go wrong in structured commodity trade finance. And it's a bit like watching the motor racing or the skiing on TV. If they start off at the top and they ski down the hill and they get to the bottom, it's pretty tedious, really, isn't it? What you really want to see is somebody fall over. It's much more interesting when somebody crashes. I don't know what it is. It's just got much higher entertainment value. And always, I think, we've always been fascinated by the deals that go wrong, the frauds. It's a great story, but I think we also have a good story to tell in trade finance as to how not to fall off your skis.
Well, I mean, it's quite interesting. Fraud's obviously been here for a while now. Sanctions aren't new. I guess, Matt, can you give a bit of an overview on and paint a bit of a picture for what you've seen in fraud and financial crime in trade over the past few decades?
Well, I think the definition of fraud has had a lot of mission creep. So there's a lot of things that people used to do in the 80s and 90s, which today would be verboten, which would be a criminal offence. When I started in a trading company as a youngster on the coffee desk, I got asked to ring up Reuters and say, is it true that there's been a report of witch's broom disease break out in Brazil? And next thing you know, there's an announcement on Reuters, rumours of witch's broom disease reported in Brazil. And about half an hour later, Brazilian Coffee Federation denies rumours of witch's broom disease. And I go back and said, no, there's no witch's broom disease. But in the meantime, the price has gone up and gone back down, and guess what the trading desk were doing? Now, today, that is illegal. Then it was quite funny. So they all thought. I think that the thing and we can point to frauds. I mean, fraud was every bloody newspaper headline in April 2020 was about commodity trade finance frauds in Singapore, in Dubai, in the US, and it was really quite tedious. Especially as I know now from having done a lot of expert witness work that very few banks involved were actually doing commodity trade finance. They were doing unsecured lending to traders, which is not quite the same thing at all. But the curse we've always had in trade finance is, if you look at other businesses, property, for example, how many property frauds have we had over the decades? When I worked in my first German bank, there was a gentleman called Mr. Schneider, and the Schneider property fraud in Germany was a case where this guy went into one branch and then another branch and then another branch of the same bank in the days when these networks didn't meet up, and took out mortgages on the same property. And this is the famous one. You may remember there was a certain CEO of Deutsche Bank who was asked how much did they lose on the Schneider property fraud, and he said, oh, it was peanuts, and it turned out to be 50 million Deutschmarks. And so that was the joke, that the definition of peanuts to Deutsche Bank was 50 million Deutschmarks. But nobody says at the end of it, well, property mortgages don't work. When we had the Atlantic whale, nobody said, well, equity trading doesn't work. When we had Jerome Kerviel, the rogue trader at Societe Generale, who cost them 4.5 billion euros, and my little connection to this is, I'm a certain age. Jerome Kerviel was born in 1979 in a village called Pont-l'Abbé in Brittany. I was in Pont-l'Abbé in Brittany in 1979. I was 19. It was that wonderful period after the pill and before AIDS, good time to be a young single man. I had a very nice time there, I have to say. I'm not saying it's definite, but I'd love to think it's possible that I played my part in costing Societe Generale 4.5 billion euros. But nobody looks at these things and say, well, that means the product doesn't work. But when it happens in trade finance, they go, oh yes, and particularly commodity trade finance, you bastards, your product doesn't work. Every time we have a fraud, this is what they say to trade finance. But the latest one is that fund in the US, is it IFS or FFS? Something like that, where the fund manager has been putting the money into the wrong things. And they say, yet another fraudulent encounter with commodity trade finance. That's not the fault of commodity trade finance. That's the fault of the fraudster doing it wrong. And I think this is something that we really ought to advertise more and get across.
So I guess, and Rod, who is responsible for fighting this crime? Is it bank risk? Is it the traders?
Look, I think just to move away from, say, the unsecured business that a lot of the banks do, but really on the secured side, I think there's a responsibility of the banks to monitor and do a better job, and I think banks have gone in that direction, more frequency of inspections, etc., using inspection companies, SMAs, CMAs, etc. But I think technology, and there's been a lot of talk at this conference, or first day one, around technology, and I think technology really has a part to play in doing a better job for the banks, and hopefully, bringing banks back to the picture in terms of financing collateralized commodities.
Well, we've actually had technology for a very long time in commodity trade finance, and those of you old enough to remember the Mexican sugar crisis in 20 years ago will remember that a lot of banks got their money back because the warehouses were all barcode controlled, they had webcams, it was all supervised, it was all monitored, and if you'd perfected your security, you got repaid. And that's how it's meant to work. That's commodity trade finance, collateralized trade finance. In theory, we've got a lot of tools to monitor the asset conversion cycle from the beginning to the end and get repaid at the end. And that's the classic self-liquidating nature of trade finance. The hard part is very few banks are doing that. And the even harder part is no regulator is telling banks to do that. The regulators have sort of dropped transactional collateral as something that they recognize or give benefit for. And when you talk to the regulators, they say, yes, but you say you've got collateral. Most of the time, actually, you haven't. Now, actually, that they might have a point there because quite often there are gaps, and the banks have got very relaxed about letting people get away with the gaps. Anybody here remember trust receipts? Who's used a trust receipt recently? I know there are trust receipts in the whole Hin Leong thing. Are they worth the paper they're written on? No. Well, they're a promise, aren't they? If you believe their promises, why are you taking all this security?
So I guess on the framework side, Basel 1, 2, and 3, and the CRR rules, have they helped fight fraud and take security into account, or would you say they're primarily being used as a credit risk mitigant?
Basel 2 was quite good. Now, Basel 2, which you've all read, of course, 243 pages, 83 pages on collateral. How much of that is on commodity trade finance? 2 paragraphs. 2 paragraphs in the whole bloody thing. There's reams and reams and reams about security collateral over securities, over equities, over commercial real estate. They even mention fashion items and shoes. There are 2 paragraphs, 2 quite short paragraphs on commodities, which actually survived through to the 2019 Basel framework. Basel 3, which is more of a sort of post-global financial crisis knee-jerk reaction to make banks safer. How many times is commodity finance mentioned in Basel 3? Anybody? 0, exactly, well, as Ivan says. 0. It's not mentioned at all. They weren't aiming at us. When Basel 3 came in to make banks safer, they weren't aiming at us. The one thing that did affect us was they brought in the leverage ratio because banks were over-levered. I remember Deutsche Bank being in the frame for being massively over-levered. And they said, well, we make banks safer by not being levered. But what does that do? Well, at the lending end of a bank, it means you bring back the return on assets target. Now, I remember being old enough when Basel 1 came in 1992, we all congratulated ourselves how intelligent we'd suddenly become because we were finally working to a set of capital rules which recognised shareholder value. And we'd moved away from those stupid days in the 1980s where we measured a bank by return on assets. And we laughed at the Japanese who carried on doing it for a while. And then you wait 20 years and you go full circle. So Basel 3 brings in the leverage ratio becomes a return on assets target. And the moment you've got a return on assets target, well, how do I get a high return on assets? I take more risk. So actually, and the other thing it did was it didn't recognize insurance. So I got to the point where at a certain point, the benefit of the counterparty rating of my insurance, my credit insurance on my loan book, did not offset the destruction of my return on assets by paying for the cost of insurance. And so where before I used to have a 10% net hold, sometimes my absolute record, I managed to do deals with a 1% hold by a bit of jiggery pokery, which the insurers accepted. And then suddenly under Basel 3, if you insured more than about 55%, then you started, your return on risk-weighted assets leveled off. You got no further improvement in the risk weighting, but your return on assets went down and down, and so we just stopped insuring so much. So after Basel 3, as a trade finance team, we took a lot more risk. And I think, well, that's probably wasn't what they wanted us to do, was it? So if there's been any help from it, I think it's been accidental. We made more money because we took more exposure. I think it's been accidental. And the latest version, the Basel framework, just doesn't recognise commercial collateral. Nothing about goods in warehouse. It's just not there.
Yeah, look, Max said a lot, and I think said it all really. I mean, Basel III, the framework, the way it's drafted anyway, it doesn't put a lot of emphasis on collateral, and that's going to make it harder, I think, for banks to get the returns that they need and really stay in the business. So I think that's a challenge for the industry that needs to be worked on.
Well, the further knock-on effect, which again I'm sure the regulators didn't mean, is because there's no capital relief for taking collateral. If you've still got a collateral management team, or if you're still going to monitor your transactional flows, where are you going to do it? Somewhere really cheap. Now, the 20 years I was at Deutsche Bank, I kept an umbrella up over my middle office in Amsterdam. And over time, they kept wanting to outsource it to the latest flavour of the month, scattered around the planet. And eventually they said, yes, we're going to set up a big back office in Birmingham. This is after we've been all around India, all around the Philippines, all around Poland. Birmingham? Well, like Birmingham, the big city. We do not have the language skills to deal with Birmingham. I'm sorry, we can't do this. The moment I left, of course, they outsourced it to India. Now, when they do this and they say, yes, but the transaction costs are 3-4 times cheaper in India than they are in Amsterdam. Yes, but when you've corrected it 6 times, it's not cheaper, is it? And then these Indian graduates who are absolutely, razor sharp, shit hot boys and girls, how long do they actually stay in that team? 6 months, and then they want to move up, don't they? They're professionals. Half of them have got PhDs, so they're ambitious. They want to move on. So basically, you end up with a collateral management team who's got 6 months' experience, and you talk to them about the sort of stuff that you can do in terms of digital monitoring, tracking the goods from cradle to grave, and they're going, which box is that? They just want to tick a box.
Yeah. So Rod, tell us more about the application of technology here.
Yeah, look, again, I think there's a lot out there, and I think common word is collaboration in terms of adopting new technologies. I think not to be too harsh on the banks, but I mean it takes a long time for a bank to adopt new technology, and there are pretty obvious reasons for that in terms of they've already got a lot of their own technology integrating, etc. There's approval processes, but there's definitely technology out there that I think can be adopted cost efficiently, that makes a lot of sense for the industry in terms of liquidity, bringing back some of the liquidity rather than it going away.
Can you give us a little bit more of an example? So let's say a wheat shipment.
So what we are focusing on using talking about the agri space, so on the grain side, we're focusing on stockpile monitoring, and then also as it's moving, so on a vessel, and then sort of on the liquid side, we do a lot in terms of real-time independent data that comes through to the banks and insurance in the industry.
And does that help the banks from a risk appetite perspective?
absolutely. Gives them more visibility. I think when you're taking a deal through your credit approval process to really show that you have a handle on where your collateral is, what volume it is, etc., is very important.
And John, you must have gone through quite a whole phase of the implementation of such solutions at Deutsche and throughout your career. Where's the line between human interaction and the add-ons tech can give?
I think the thing that I'm slightly cautious about with tech is that when you see it on a computer, on a screen, it rather sort of sanitizes it. You don't get the smell of it and the feel of it. The Fingerspitzengefühl, as the Germans say. It seems a lot cleaner because it's all on the screen. Technology has come a very long way, and I think if you look, in Australia, they take it for granted, but when you go around the Pilbara and you've got these big sort of mining areas, everything is driverless. There is huge, 200-ton trucks going around, the sort of thing where the hubcap is at eye level, and there's no driver because it's all controlled from space, and the controller is like 200-300 miles away, sitting in a room that looks like the bridge of the Starship Enterprise, and his screen looks like he's looking out of a window at the mining area. And that's all very impressive. But on the other hand, I remember getting a lovely set of photographs about the warehouse we were building in Nigeria when I was working in a trading company, showing how it sort of rose up and majestically appeared and looked like a fantastic place to put your commodities. And then at a certain stage, we wanted to put some stuff in it, and they said, "Oh no, you can't, not yet, not quite ready." And this went on for a couple of weeks, and then in the end, the boss said, "Mac, you're up next, down to Nigeria, go and have a look." And I drove for 3 hours out from Akure and found the place, and the grass was at nipple height on me. So clearly not much had happened there for a while, and there was no roof. There weren't even 4 walls. There were 2 walls. They said, no, well, there were 4, but we had this terrible storm and 2 of them fell down. And I said, well, where have the pictures been coming from? Oh, that's McGregor's warehouse next door. And when this one's finished, it'll look exactly like that one. I was like, oh, thanks. So, but I've always said, you've got to have a travel budget. You've got to have a pair of boots. You've got to be prepared to use them. It's a great line of work if you're into industrial tourism. And you go down there and you talk to people. And quite often, a lot of us who work in the big financial hubs like London, you go to Metals Week, you go to IP Week, you go to Sugar Week, whatever it is, and you meet the smooth-talking bastard down at West End Hotel who's telling you what a fantastic business he's got and please give me all your money. And then you go down the ground and you talk to the guys on the ground, and you might get a slightly different story. And I always believe in asking the guys on the ground questions, just to see if it all matches up. And often they've not been prepared. They'll tell you the truth, the horrible truth. I turned up like this to a copper smelter in Zambia, and I asked them about their safety record, and they said, well, yes, tragically, they had a death just the previous week, and it was as the crucible was coming around out of the smelter, they went in with these what do they call them? The arc, basically a big stick that lights up to clean out the crucible, and the whole thing exploded and splattered the guy with molten copper. And I said, where was this? They said, oh, it's just around here, and I'm in a suit, and there's this bloody firing away, looking very dangerous. I thought, time to go. But there is no substitute for that. I think, yes, use tech, and it'll save you a lot of money, but you've also got to do the physical due diligence. And even that won't defend you from a determined fraudster. There is no way to structure for fraud. It's a hard part.
No, agreed. Certainly in our world of Veridapt, we don't think we're the one solution, but there's absolutely still room for the physical checks. You have to go there, smell it, feel it. But technology's got a role to play there to be a bit more real time, and also, as I mentioned earlier, I think independence.
Can you give an example of how they can be complementary? So, say a CMA working with that software.
So we're working with CMAs, SMAs, where they continue to do the physical checks themselves, but we're installing our technology so the customer can see real time and independent all the time. And really, it is. I mean, most customers don't want to see every minute, which can be provided, but it might be daily rather than looking backwards. In the world of banking, some of the information that banks receive, it could be a month old or even older. And obviously, if you've got a problem, you're not going to be going too well if it's that old.
Well, we went through a whole range of this experience in Germany. Every country in Europe has a different law of pledge, and they're not just a little bit different, they're wildly different. And in Germany, what you get is a map of the plant, and the building where the goods are, you draw a red line around that, and you write a number in it, and that's the volume of the goods that are in there, and then you register that, and that's your pledge. And when you turned up from Amsterdam saying, I'm here to help in Germany, of course, they're really pleased to see you. And you have this conversation about, yeah, we do all this already. Well, how often do you do it? We do it once a year from the annual report. And what's their stock turnover? It's about 55 days. I don't know why it's always 55 days. It's like 55 days sounds plausible. It's not too round a number. But that means after the first 55 days, their pledge is invalid, doesn't it? And there was another one we said, well, how often do you get the report? Yeah, if it gets the report every 2 weeks. I said, well, that's maybe quite hard for them to do because that's outside the management reporting cycle, which is usually monthly. Yeah, if you have to get them 4 weeks to produce the report. Why don't you make them do it monthly and give them 2 weeks to produce the report, and you've got a more up-to-date report which you can then reconcile to their audited numbers. And there's a certain amount of devil in the detail. It depends on the client, though, as to whether you're talking about that sort of floating charge stuff where you check it monthly, or whether you're talking about the smaller trader down by the docks where you want somebody on the gate checking everything going out and everything going in. And that's a question of how much do you trust them, really. And I think the other aspect of due diligence, which I think goes along in hand with technology, is probably alcohol. I do like to go drinking with the client and their people on the ground and the warehouse guys and the factory guys. Shakespeare said, what is said when drunk is thought when sober. There's a lot of truth in that. And that's when all the secrets come out. And it's at 3 o'clock in the morning when you've got them completely legless that the secrets come out. And then you start finding out, is this somebody you really want to work with?
So we've talked about... I'm trying to find a segue into the next question. I can't. I'm going to go into the next question. Rod, cybercrime, discuss.
So cybercrime, I mean, not my expertise, but I being in technology now, the importance of protecting basic things like passwords, right? And we talked a little bit before. There was the situation, the Colonial Pipeline in the US recently, and I understand it was really a password that hackers got into the system, and I guess the point is that it is so important because that it's the largest pipeline in the US. It went down for about a week, but it created huge problems in the market, and then there was panic buying and prices spiked, etc. But something so simple in terms of cyber security can be really cause a lot of problems.
I mean, Mac, from your perspective, how resilient do you think banks and commodity trading platforms are for just those basic things like single sign-on, DDoS attacks, just that basic element of security?
It's difficult to say because it's a balancing act, isn't it? I mean, one of the things that we had working in a big bank was we were told every system that you used had to have a different password. You couldn't have one password for all systems. You had to change the password every month or 3 months, depending on what system it was. And you couldn't use any of the passwords you'd used for the last 3 years. And you start thinking, I'm running out of words, actually. And then they suggest passwords for you, and it will be a password that you couldn't possibly memorize or do anything with except write it down and stick it to the top of your computer, which is probably not the best thing to do when you're trying to keep things safe. And of course, these days, they've got much quicker at trawling through stuff. I got invited to an anti-bribery and corruption seminar at Liverpool Street Station, which I had to walk past anyway to go home. And the incentive to go to this anti-bribery and corruption seminar was a free wine tasting. I thought, yeah, that sounds about right, doesn't it? And it was an excuse to get out of the office reasonably early, and so I went along to this thing. And there was these ex-CIA guys, and they had this sort of 10-year-old CIA technology. When I was in a court case 10 years ago, 15 years ago, and they wanted to trawl your inbox, I'm thinking, good luck, you know. And they put in a few keywords and search for things, and I had a process where they only looked at about 10 months of my emails. It was like 70,000 emails, and they're looking through it. Some poor schmuck had to sit there reading that lot. And it took them months. It took them about 7 months to come back and say, well, these are the emails we want to look into. Now, apparently, they can do that in nanoseconds. They've got these algorithms that they put in that search through everything, and they'll look for stuff like, have you used a lot of exclamation marks? Because that might mean collusion. It might mean you're talking to a pal. Have you said mate? Have you said buddy? Does that mean that you've got too close a relationship with the other guy, that you're doing something that you shouldn't be doing? And they can do it in a heartbeat. And so the technology is getting more and more invasive all the time. And of course, it's impossible not to live with technology. But they know where you are all the time. They know pretty much what you're doing. All this stuff is listening to us. How many times have you talked to your partner about, oh yeah, we might need a new garden chair, and then you go onto Facebook, next thing you know, you're bombarded with adverts of bloody garden chairs. You can't live without it, but you've got to have that pair of boots and the travel budget as well, and do that stuff too, I think.
Thank you very much, Mac. And I guess just a concluding question to you both. And it seems like there is a bit of a business rationale now to really think about implementing technology to fight fraud. But I guess given the changing market post-pandemic, a huge shift towards e-commerce transactions, I assume hackers are probably quite bored and going for computers now rather than physical shipments. But what would your advice be for perhaps for traders, producers, and lenders? Rod, I'll get you to start.
Sure thing. Look, I think particularly in this environment, right? I mean, commodity prices, we're going through a cycle, or some might call it a super cycle. So I guess people are more encouraged to commit fraud in commodities. So look, I think technology definitely has a role to play. You know, there's been a lot of big players that have left the market because, you know, they've had challenges in that regard. So I think it's important to bring that technology along with some existing practices, and I think you can bring a lot of protection for the market.
I don't think we're quite there yet with this technology. And if you look at the Singapore frauds, for example, where you've got all varieties of inventory fraud, you've got multiple pledging of the same cargo. You've got pledging of non-existent cargoes. You've got flash title on cargoes, which is flashed more times than a streaker on boat race day. You've got all these varieties of different types of fraud. You think, well, how would the tech work? We've had for a long time the ability to look at a bill of lading, look up the ship's name, and for free on the internet you can find out where that ship is. You can see where it last went, you can see where it's going. You can check, has it been to North Korea recently? Has it been to Cuba? You can check, is it going somewhere? You can check. My client's telling me it's in the Indian Ocean, and you look it up and it's off the coast of Shanghai. All that you can do. What you can't do is necessarily nail down the parcel that's on the ship. You may be able to check the bill of lading in more detail, but you can't tell who's holding the bill of lading, you can't tell who's owning the cargo or who's controlling the cargo, and I think that's the next step. And we've just now got the electronic bill of lading stuff get through again in the UK, and that's meant to be a global initiative. It's been a global initiative since 1996, as well as I can tell, and we're still waiting for it to be quite enshrined everywhere. But I think when English law does it, that carries a lot of people with them. But it's that sort of, how do I tell if somebody's already financed this parcel? That's the really hard part.
So yeah, look, I think also just to add there, I think, you know, registries, I mean, that's coming, and I think certain markets like Singapore are making good steps in that regard, but it comes back to collaboration, right, and setting up registries so you can, you know, players can really check and verify and see, you know, who has a security interest over a particular cargo.
And there are lots of guys like you who've got this really nice product, but half these products don't talk to each other. And so they're like little islands, little technology islands scattered around, and we really need them to connect up.
Thank you very much, Rod and Mac. And if you don't mind, I'm just going to take 2 minutes just to make a couple of kind of closing remarks. I'm very conscious I'm sitting between Mac and wine. Free wine, free wine. I guess transition was the word that started the day, and in the session with Richard, Carl, Alistair, and Thierry, 88% of you thought that trade finance was not available or well suited to the needs of the market. And the macroeconomic arena continues to change, and what was once quite a profitable, lucrative arena or industry, it continues to change and is getting harder given the politicization of trade away from free trade, reduced liquidity in the market, and the changing balance of power away from the dollar. Now, trade finance is certainly undergoing digitalization, which is my next buzzword, which seems like the journey away from paper documents. Not only are they replacing paper documents, but seems like a good solution for paper. Paper was quite a good standard, but it's not great when we're not in the office. The next important word was adoption. A good question was raised. What's holding digitalization back? And the speed of change is slow. The pandemic has sped things up, but time to adopt is taking a long, long time, as alluded to by Rod and Josh's session. After lunch, we addressed the elephant in the room, the impact of the Russia-Ukraine war on liquidity and access to finance, and had a pragmatic conversation about whether banks, funds or alternatives should finance commodity trade finance moving forwards, with Mac, Daniel, Mark and Rakesh. The afternoon continued with discussions around the importance of governance for greening up supply chains, both in Bhavtik and Alex's session and Elsa, Swaroop, Nahir and Arafat's session, particularly with the focus on the business imperative to implement ESG from both a trader and lender perspective. And finally, fraud. Rod and Matt gave a really good overview of what the past 30 years of fraud has looked like, how it's evolving, and the use cases for tech. I'd like to thank Richard for being a super panel co-host today, and also to the entire Commodities People team, Samantha, Ben, Marie, and everyone else for making today possible. Transition, digitalization, adoption, liquidity, and governance. Thank you very much. We welcome you downstairs for drinks.